In this next section, we're looking at section 11O. I'll work with the first example I'll write out, and the rest of it will just talk about the concept. Okay, so pay attention to the calculation here and the basic principle. A Limited is registered VAT vendor for 31 December year end. A Limited purchased a new machine at a cost of R1,000,000 on the 1st of August 2013. So that's in the 2013 year. And started using it immediately in the process of manufacture. Right, so that's important for us when we started using it. Demand for the product produced by the machine declined quickly, and on the 1st of September 2015, A Limited disposed of the machine towards market value of 80,000 Rand. The buyer was going to scrap it. For the 2015 year of assessment, A Limited had other taxable income of R1,000,000 and a capital gain from the disposal of other assets of 50,000 Rand. I ask you to calculate the effect on taxable income for A Limited for 2015 if it elects to apply Section 11O and if it does not elect to apply Section 11O. Okay, so important for us to see that, how it works. So we'll start with the cost. Less allowances purchased in 2013 would have claimed a 40% allowance. 2014 we would have claimed a 20% allowance. And then 2015, which is our current year, we would have also claimed 200,000. So make sure you remember to take that into account in the current year. Okay, so that leaves us with a tax value of 200,000. Selling price limited to our original cost. The selling price in this case is 80,000 rands. Original cost is R1,000,000. So the lower of the two, 80,000. So 80,000 minus 200,000 gives us 120,000 rands as a negative amount. Now, if we apply Section 11O, then we claim that 120,000 rands. So this is important for you to see now. Right, we claim that 120,000 rands. Then, when we calculate our capital gain, remember you must calculate capital gain when there's a disposal of an asset. It is the proceeds amount, which is the selling price, minus the recoupment. There was no recoupment, so it's 80,000. Our base cost is then the cost of the asset originally, which is R1,000,000, less our allowances. And what I mean of allowances is the sum here. So 800,000. And then anything else that you've claimed in respect of the cost of this asset has that 120,000 rands over there. Okay, so now when we calculate our capital gain, well, our base cost is 80,000 rands, so we've made no capital gain, no capital loss. Right, so that's important for me that you see what happens here. Okay, with these highlighted amounts. So that is what would happen in situation A. In situation B, what happens if they do not apply Section 11O? So I want you to see that the first part of our calculation is exactly the same. Right, now we selected Section 11O to apply previously. Now we'll say Section 11O does not apply. Why? Taxpayer did not choose it. So we don't get that deduction. Then when we calculate our base cost, we said the Section 11O amount must be deducted. But if we don't have Section 11O, then that becomes a null. So then our base cost is 200,000 rands and we have a capital loss of 120. So I want you to see what happened. We first claimed 120,000 rands when we selected to apply Section 11.0, and then our capital gain was null. But if we don't apply the 120,000 rands, then we can't take into account our base cost, so then we have a capital loss. So your decision to claim Section 11.0 or not moves it from a deduction to a capital loss. Which one is better for you? Definitely the deduction always, because that is taxed at 28%. So guys, I want you to see here, look at the effect on taxable income. Situation A, 1,080,000. Situation B, 1,104,000. So you're paying more taxable income in situation B. Alright, so now that we understand how that works, now just a couple of small rules. So D Limited is a registered vendor for December year. They purchased a factory building at a cost of 2 million rands, bought into use immediately, and they sold it for 400,000 rands in 2015. So what I want you to see is we calculate, when we do the calculation, you can now do it at this point in time, you have a 200,000 rands loss. Now if you want to apply Section 11.0, it will make that 200,000 rand loss in our rands column. However, this is a building, so Section 11.0 cannot apply to it. So it's going to end up as a capital loss for us. Right, so see, make sure that you see there you can't apply it. Situation 3, Q Limited is a registered vendor for December year end. They purchased a new machine for 500,000 rands, using it immediately in production of income. The market conditions changed and the company was only able to sell the machine for 80,000 rands. In terms of interpretation note 47, the machine has a useful life of 12 years. But now important. What happens if the machine qualified for Section 12C allowance? If it had qualified for the Section 12C allowance, I want you to understand that its useful life is then 40, 20, 20, 20, which is 4 years, or 5 years if it's a second-hand one where you claim it over 5 years. So, if Section 12C applies, we do our normal calculation, we have a loss, we can claim that as a Section 11.0 loss. It means then we have no capital gain, there we go. But now, look at Situation B. Situation B says, assume that this is not used in the process of manufacture and it does not qualify for Section 12C, and that they will still elect Section 11.0 if they can. Now the problem is that it has a useful life of 12 years. So when you do this calculation, right, you will still do the calculation as usual and you calculate a loss. The problem is that you can only use Section 11.0 if it is for 10 years or less. It can't exceed 10 years the useful life. So that 329, you want to claim it. You can't claim it because it's for more than 10 years, so it basically ends up as a capital loss for you when you do your calculation. Example 4, J Limited is a registered VAT vendor for 31 December year, purchased a new machine for 1 million rands, used in the process of manufacture, and then they sold it to a connected person. Right, connected person is the problem, so although you make a loss, because it is to a connected person, you can't claim the loss, and it ends up basically as a capital loss for us. So make sure you guys can understand these examples.